one of the things that, again, I think is interesting about globalization, and Jonathan mentioned it, Lorena mentioned it, a couple of people in our last panel mentioned it, is the importance of standards and having a common expression for carbon, a common expression for ESG performance in investment in general. Building on the SDGs and actually crafting KPIs around them. Regulation, unfortunately, mostly happens, not even at a national level, but at a local level. What do you see in terms of trends for collaborative regulation, or regulation moving for, or do you see any trends about regulation becoming, I'm thinking, especially at the local level, more harmonized, so that, again, innovators who want to put forward global solutions can come up with something that is regulatorily compliant where their place of business is, but also adaptable on a more global level?
Thank you for this question, actually. Before I actually answer this, I was trying to explain my, around 7 years back, to my 11-year-old daughter about ESG and impact. And she had recently seen the movie Titanic at that point of time. And she said, after I explained whatever I could, what she understood was, oh, so you basically mean the world is like Titanic as a ship, just getting into an iceberg, and the captain is sleeping without Leo and Kate. And at that point of time, I realized that creating a narrative, a simple narrative for the conversation that we are having on this panel and beyond, for the youth and the individual and community stakeholders, is absolutely critical, because these are the pressure points and the consumers that would actually make regulatory changes and institutional changes. And it's absolutely critical that I think making ESG conversations and impact conversations part of the basic primary and secondary curriculums at local and regional levels is absolutely critical. Moving to the institutional and systemic transformation and importance of regulation in that, we recently actually, in Pakistan, we launched this intervention called NSAGov. And the idea was very simple. So we got together the Stock Exchange of Pakistan, we got the SECPs, we got Unilever, top financial services institutions, cement industries, textile institutions. And the conversation was basically saying that the listed companies' share value, the price, is basically determined on sentiments and financial performance. And right now, the ESG disclosures are voluntary. What if we actually created a mandatory framework where the listed companies' share value would actually be determined on these 3 segments rather than 2? Everyone was on board, at least in theory. Now, the challenge is that in Pakistan, I'll give you the context of Pakistan. So Pakistan's largest export industry is textiles. And GSP plus status in Europe basically means that import of textiles would require certain measures and frameworks. And in the coming years, ESG would become a very, very important compliance reasoning for that export to continue and progress. Now, if the textile industry would not invest, now it's a very clear business case. If they wouldn't invest in these mechanisms, they would lose business. And for that, they're willing to actually make a lot of investments. So on institutional level, there's a very strong business case. The global expansion is not going to happen if ESG compliance is not going to be interwoven into the principles, policies, products across their value value systems, as well as the supply and distribution communities. And on regulatory level, the governments are actually learning that how much revenues they're losing and how contaminated, their geographies are being made by these institutions who are not compliant. So the timing is absolutely critical, and it's apt for interventions like these on institutional and systemic level, and it's happening actually.
Of course, Mark Carney, another Canadian who was chair of the Bank of England, initiated the TCFD, the Task Force for Climate-Related Financial Disclosure, and again, it's a very realpolitik kind of observation that climate risk presents big risk for financial institutions, and therefore his point was big institutions, banks, and insurance companies need to understand and disclose these risks before they become systemic. Only a few weeks ago, the SEC in the United States has now made climate risk disclosure mandatory for US publicly listed companies. So this regulatory change is being driven by the real understanding of the economic, not moral and ethical, the economic impacts of how this is hitting us all. I think what's interesting is it's still moving too slow. I think we're all in agreement there. The PRI, the Principles for Responsible Investment, have something called a thesis and a set of work that they produce called the Inevitable Policy Response. And the IPR basically puts forward the case that the impacts of climate change are becoming more and more severe. The droughts, the storms, the flooding, and the economic impact is becoming so severe that if we do not address it in a sort of gradual way, at some point there will be a lashback of society. And when that happens, then the regulatory response will almost be too hard, and that can have big impact on asset classes like real estate, like the equity market and the bond market. So the IPR in their analysis says, under the Paris Agreement, every 5 years we take a stock take. And the stock take is we meet as all the countries of the world and we say, how are we doing? How are we doing to address? And under the IPR, they feel that around 2028 is the next major stock take. And based on what's happening, that is likely to be, we're not doing very well. And therefore, the response, the backlash, could be quite significant. So these are real systemic risks that we need to address. But like the earlier panel, every one of these problems is an opportunity. And in many cases, it's a financial opportunity, and therefore it drives innovation, particularly by young people, because they are going to have to face this. So, hopefully, I'm hopeful that human ingenuity is going to really help here.
A lot of the newest innovations, newest investment spaces are around areas of unlimited supply, or to the extent that there are limits, those limits are artificially imposed. Crypto, NFTs, metaverse, IP in general, these are all limited. I want to go back and talk about the oldest investment opportunity and the one with the most limited supply, which is land. How are all of these emerging technologies changing the way in which investment and operation of real estate is happening?
It's a very short question with an enormously long answer, which I'll try and bring down. First of all, I'd like to say I completely agree with what you said, and I would further add that carbon markets, in terms of addressing climate change, are a scratch on the butt of a flea on the back of a pack of dogs. It is tiny in terms of what it's going to do. The reality is that in 2020, 34 gigatons of carbon were emitted. Last year, it was even more, despite the pandemic and everything else. And that continues. We haven't even stopped the rise yet, let alone addressed the reduction. So real estate is an important part. Real estate represents 40% of carbon emissions. If you look at the construction and the operation of real estate, it's an enormous issue. And despite huge investment in prop tech in general over the last several years, there is relatively little progress being made. And that comes from a number of, because of a number of reasons. The first is that real estate, and just to give you a little bit of background, I spent 20 years in strategy consulting for people like IBM and so on, my own consultancy, around how emerging technologies would drive businesses and so on. I've spent 15 years in the environmental space, a bit of overlap in all of that. And today I happen to be here as founder of AirSensor, which is one of the companies that I have at the moment. But all of those things really are focused around data acquisition and understanding what's going on. So in all of that experience, real estate is an enormously tech laggard industry. It is.
Why is that?
It just hasn't had to be at the forefront of tech. People don't do things generally in business, and I'm being very broad brush here, apologies to anybody who isn't like this, but they don't tend to do these until they're forced to do so. So that's why regulation is important. That's why rules are important, compliance and so on and so forth. And in the real estate industry, they haven't had to. It's been buoyant for a very long time. As they say, God ain't making any more land, so it's a finite resource. So they haven't had to do any of that stuff. And what you see now is this confluence of post-COVID environment, a huge uptick in the requirement around ESG reporting and climate impact and so on. And the result of that is pressure on real estate in terms of occupancy levels, pressure on people to be reporting to ESG and climate and so on and so forth. What's actually happening so far is relatively small. You've seen prop tech investments, the majority of them that are making progress are in things like Zoopla, or finding tenancy stuff for commercial real estate, or tenant apps to help people, sort of book rooms in tenants and so on. In the actual real estate ownership level, it is quite disturbing what's going on in terms of things like carbon reporting, because what you're seeing in the big REITs and the big owners, they tend to be trying to do offsetting, which is like buying indulgences from the Catholic Church, right? it doesn't get you anywhere with climate change. So if you honestly look this up, some of the biggest real estate owners have now started buying huge swathes of highland land, or bits of Australia and so on, or Brazil and so on, and they're going to be planting things or whatever it happens to be, which is it's awful. It's really not going to make any difference. What they have to be focusing on, if they're really going to get to where they need to be, is on operational efficiency, on energy reductions, on improving the well-being and the environment for occupants, because obviously people want, they want to get people back into space. They have to be focused on this stuff, and they're doing it very spottily, very patchily.
I want to talk about, since this is a global expansion conference, how innovators get access to the things they need. Money, yes, but advice, business expertise, technology expertise. Typically, some of the best sources for these things are national in scope. Here in the UK, like Innovate UK, most governments have, whether it's through a desire to just boost their industrial competitiveness or through more targeted industrial policy, ways of helping countries in that country succeed. But a lot of the things we're talking about are solutions that only make sense when they are handled with a global scope. So my question for you, Lorena, is what advice can you give to innovators, to investors who are looking for access to advice, to money, to expertise for global solutions which may not be covered by the scope of Innovate UK or the scope of any other nationally focused source of expertise? Where can companies with global solutions go?
Well, thank you for the question. I think that nowadays it's all global. So finally, when you map all the ecosystem regarding to these issues, you can find how different kind of government are being able to help you. Could be here in UK, a lot of institutions, a lot of investment on these kind of things. But you can find as well what is happening in the United States. And nowadays, even the teams from one company are global. So I think that it's a bit strange to find some teams nowadays working on innovation and tech companies who belong to the same country. So nowadays, for example, in my experience just regarding to NFTs and blockchain and all these kind of things, where we were running in a team running globally. It's all global nowadays. So you can access, for example, in one company who has been working with, they access to money from the state money from different areas, from India, from Pakistan, from United States, from UK. Amazing, but this is the nowadays how the business have been going ahead. So I think that when you think about how to go in there, if the team is global, it's because the challenge is global and the necessities of this kind of product or service is global, and the money is global as well.
Now, you all come from very, very diverse backgrounds, but I'm going to stick my neck out and make a guess that one problem you all share is that you would like to get better access to money. Now, that expresses itself differently. Universities are thinking about how to win grants or pitch to their alumni. Startups looking at venture firms, even within big enterprises, getting investment from their boards. And one of the critical success factors historically throughout history, if you want to get somebody to invest, is to have an in-person relationship, to meet them, impress them, get to know them, build a relationship. Even before COVID, that was starting to change, and investment decisions were being made increasingly on a purely virtual basis. That has accelerated, obviously, due to the pandemic. We've seen lots of investments now being made where the investor and the enterprise being invested in have never met in person. So you are all investment experts. What tactical advice can you give? How is it different pitching virtually to pitching in a traditional way? And what have you seen that works and doesn't work? How can you advise our audience?